So why originate DPA? This is for credit-worthy borrowers who just simply need help with the down payment. So I always tell everybody that these are for borrowers who otherwise meet FHA guidelines. They just need assistance with that down payment. Also, you're going to build some new realtor relationships with this, and it's an easy way to just quickly get more loans in your pipeline and close more loans. Also, a recent change in our DPA programs, you can go up to 2.75 now on borrower paid comp. Just a quick reminder, none of these allow lender paid comp. So how does it work? If you're not familiar with how down payment assistance works, it's assistance in the form of a second mortgage. So you're going to have that normal 96.5% FHA first mortgage, plus a 3.5% second mortgage. So your CLTV is going to be 100% or even higher in some cases. Closing costs, I highly recommend getting seller contributions on these to cover some of the closing costs, but it can also, any of the leftover funds can also come from the borrower or a gift or even outside other DPA programs or grants as well. You can layer these. So the two DPA programs that we have right now are Aurora and Boost. Boost is through National Homebuyer Funds, and Aurora is through Tool River Finance Authority. We handle both of these completely in-house. Aurora has forgivable and repayable options. Boost is a repayable DPA. We have full underwriting authority on both, so there's not any outside review needed on these, which is awesome. It helps you close these quicker, and you can close these inside 30 days. So anytime you guys want to know what our current turn times are, you can just hop into our portal, click on current turn times. This is what we're running right now, but we keep this updated and live for you. So the two main types are forgivable and repayable DPA. We're going to compare the two. Anytime that you need the lowest DTI possible, you're going to want to go with a forgivable DPA option. The repayable DPA, in contrast, is going to result in the lower funds to close. We are going to go through examples so you can see exactly how these work. Forgivable has no payments due on the second mortgage. The trade-off is these are often at a discount point, which they are right now. So seller contributions on forgivable DPA are essential, especially in the current market right now with the current pricing. You do not, under any circumstances, want to originate a forgivable DPA without very high seller contributions. And I want to drive that home because you're going to be disappointed if you register a forgivable DPA without seller contributions. There's not going to be a benefit there based on the current market. So make sure any forgivable DPA, high seller contributions, 5-6%, and we're going to go through some examples. There's a 0% rate on that second mortgage as well, no payments due. The benefit that what people like about that forgivable is after 36 months of on-time payments on the first mortgage, that second mortgage can be forgiven. If they do have a 30-day late that would hit their credit report, then that 36 months period is going to start over. So as soon as they've had 36 months consecutively, no lates, they can forgive that second mortgage on the forgivable DPA. So the repayable DPA, in contrast, is going to have lower funds to close. So you can originate these without seller contributions. We're going to look at some examples, or low seller contributions. But the trade-off is that there are going to be monthly payments due on that second mortgage, and you do need to include that second mortgage payment in the DTI. So repayable DPA is not going to be the best for your borrowers who are already at a high DTI, because this is going to drive the DTI up higher. The plus of the repayable DPA is that the pricing often has a lender credit, which it does today. We're going to look at some pricing examples here in just a second. Seller contributions are helpful for sure with repayable DPA. In fact, I recommend it on all of the DPA, but they're not absolutely essential on repayable DPA if the borrower can cover their closing costs. The rate on the second, since these are repayable, they're going to have a payment on the first every month, or payment on the second. The rate on the second is going to be just too higher than the rate on the first. So quick example, rate on the first, 7.75. Rate on the second would be 9.75. These are not forgivable, so it works kind of like a true second mortgage, and you're either going to have a 10-year term or 15-year term, depending on which program you go with on the repayable DPA on the second mortgage. So in order to understand how these work, you really have to understand the pricing and look at an example. So that's what we're going to do right here. So if you're multitasking, I would stop. We're going to look at a real life pricing example based on today's pricing on the forgivable Aurora. And then we're going to look at the repayable Boost and compare the two apples to apples. So remember, on forgivable, this is the one where no questions asked. You have to have high seller contributions, 5-6%. Otherwise, the forgivable will not make sense. And I'm going to show you why. So this is a pricing example that I ran this morning on the forgivable Aurora. I'm just going to use a 660 credit score as an example. The highest rate on the rate sheet today is 8.25 on this one. You're almost always going to want to go with the highest rate on the rate sheet because you want to keep the funds to close as low as possible to maximize the benefit. And based on today's pricing, there are about 3 discount points. So you've got to have those seller contributions. Let's break it out here. So when you're calculating how much this borrower would need to bring to the closing table on forgivable Aurora based on today, we've got discount points, a little bit over 10 grand here. Our lender fee on DPA is a little higher than our standard FHA, so it's $12.95. You can include it in the pricing. If you check it here, it's just going to make your discount points go a little higher. So I didn't include it. I'm going to list it separately. Borrower paid comp, as I mentioned, this Aurora DPA actually allows up to whatever will pass QM. So you can, in theory, go up to 2.75 on the Aurora forgivable, but I'm just going to use 2.5 so we can compare apples to apples here. So this would be your borrower paid comp. Let's just say your closing costs and prepaids total $6 grand for this example, depending on when you close, and your state could be higher, could be lower. And that total is a little bit over 26,000. So this is why I said with forgivable DPA, don't even look at it unless you have high seller contributions. So we're gonna say on this example, we have the maximum FHA allows, which is 6%. That's going to be 21 grand on this purchase price of $350, and that leaves the borrower coming to the table with just over $5,000. So that $5,000 that the borrower needs to bring, that can come from borrower funds. It can be a gift. It can also be paired with other grants or other outside DPA programs. But you can see, based on the breakout of these numbers, if you didn't have the 6% in seller contributions, the borrower would be coming to the table with over $26,000. So that is why I just cannot stress enough, do not look at forgivable DPA unless you have high seller contributions. It just will not make sense. So now we're going to switch to the repayable pricing example so that you can see the difference, and that one you can manage without seller contributions. So let's take a look at our 3.5% repayable Boost based on today's pricing. I'm going to just compare apples to apples, same purchase price, same credit score. Highest rate on the rate sheet is 8.25. You can see there's no discount points. We've got a little bit of a lender credit. So let's do the funds to close on this example. No discount points. The lender fee still $12.95. Borrower paid comp, we're going to do 2.5. Closing costs and prepaids, we're going to say $6 grand, but that total is $15,738. So now we can apply our lender credit that we have on today's pricing. By the way, sometimes it's higher, sometimes it's lower. You got to calculate, just jump into our quick pricer and price it out. By the way, if there's anybody on the call that doesn't have credentials for our portal, just email STAR help, that's STAR help at orionlending.com. They typically issue credentials within 2 business hours. So we're going to take out that lender credit that we get. That's going to leave the borrower coming to the table with $13,924. Now this is with 0 seller contributions. So this is a great fit for a contract that you have with no seller contributions, but the borrower can cover, you know, that 13,000 with their own funds or a gift. Now, can you have seller contributions with this program? Absolutely, you can. So in this pricing example, if they had 4% in seller contributions on the contract, they would come to the table with pretty much nothing if you do the math. So if you do have a borrower who cannot bring anything at all to the closing table, then you're going to want to look at the repayable DPA, and you're going to want to try to get seller contributions to cover that overage. So yeah, this 13.9 would be this example with no seller contributions, but if they had 4% in seller contributions, they would come to the table with pretty much nothing on this scenario. So who is eligible for Orion down payment assistance? As I mentioned before, these are for borrowers who otherwise meet FHA guidelines. They're creditworthy. They could do an FHA loan if they had the down payment. So that is who this is for. Our programs are expansive. They're for first-time home buyers, but they're also for non-first-time home buyers. So we try to keep our guidelines as flexible as possible. All occupation types, I know there's some out there that you have to be in a specific field. Ours are not like that. And we have options for low all the way to high income borrowers, and we're going to look at those in just a second. So this is what we looked at before, comparing forgivable and repayable, but we're going to compare our forgivable Aurora to our repayable Boost, which are the two most popular options that come in. Just a reminder, if you have somebody who has a high DTI, you need to look at forgivable, because if you do repayable, we're going to need to include that second mortgage payment in the DTI, and it's probably going to blow it out of the water and it may not work. So forgivable is best for high where you need to lower the DTI. Just remember, that's the one that has to have seller contributions. So our forgivable Aurora is for 600 plus scores. Our repayable Boost actually goes down to a 580, which is awesome. Forgivable Aurora goes up to 160% AMI, as does repayable Boost. We have a program that I'm not doing a deep dive in today called our repayable Aurora, which has no income limit. So if you have somebody that's over, let me know. We can discuss that one as well. But let me show you, because these are really high. So this is where you're going to go to do the area median income lookup. You can Google it. It'll take you there. You can scan this QR code. It'll take you there. So let's look at Georgia, Fulton County, the Atlanta area. That's where I am. We do a lot of loans there. Let's see what the family median income. So family median income in this area is 103,500. Now you can take 160% of that. So 160% of that is 165,600. And this is not like USDA, where you have to count everybody in the household into that cap. We're not doing that. We're looking at just our borrower or borrowers on our loan and just the income that they're using to qualify. So let's say that you only need their salary to qualify. You don't need the bonus that they get every year. You can leave that bonus off the 1003 if it's going to throw you over the cap. It's just the income types that we need to qualify that we're counting in that cap, and just the borrowers on our loan. So this is going to accommodate most of your borrowers who need down payment assistance. We're not usually seeing these DPA loans come in with incomes much higher than this that need down payment assistance. But again, if you have somebody that is over the cap, we do have a repayable Aurora that has no income cap that we can fit them in. So the Aurora program goes up to 2 units, whereas the Boost actually allows up to 4 units. So if they are buying a 4 unit and they're going to live in one of the units and rent the other ones out, you can actually do that with down payment assistance, which is awesome. Both programs allow double wides or larger per FHA guidelines. So you're going to be looking for a permanent foundation, June 1976 or later, all that good stuff. And condos and PUDs as well. Just a sidebar, if you guys have already ordered, if the loan has been somewhere else and you're transferring the case number to us, we do welcome transferred appraisals without a problem. If this is a new file that you're originating with us, the appraisal has not been ordered. It does need to be ordered in our portal. Our site is so easy. Ordering the appraisal is easy. We have over 15 AMCs that we're signed up with. You guys don't have to sign up with them. We're signed up with them. We're the lender on the appraisal. So you can pick anybody that you want from the drop down when ordering. They automatically pull back into our portal and task to the underwriter. No action needed on your part. We order all the revisions. If you have a borrower who doesn't want to share their credit card information with you, you can go ahead and order and defer payment when ordering. And then you can send them a link where they look up the property address and they can place the payment on their side. So as I mentioned, our Aurora has no max borrower paid comp as long as it passes QM, which, so we have a lot of these coming in at 2.75%, and Boost allows up to 2.5%. There's no lender paid comp on these loans. They're all borrower paid compensation, and your compensation you're getting is just on the first mortgage. You're not getting any compensation on the tiny 3.5% second mortgage. It's just the first. As I mentioned, first-time home buyers are fine, but it's not a requirement of our DPA programs. This part is awesome. The DTI, as long as it's approved eligible, is just per the DU. The only exception to that would be the very low scores for Boost, the 580 to 599. Those are capped at 45%. So as long as you're 600 plus and approved eligible, and it's not a manual underwrite, then there's no DTI cap. We do allow manual underwriting on these, which I think is important for a lender originating down payment assistance loans, because a lot of these, as you guys know who do these, a lot of them do refer. So we're going to do a deeper dive into manual underwriting here in just a few seconds on what HUD requires on those. So non-occupying co-borrowers are allowed on both programs. Aurora is nationwide except New York. Boost is nationwide except Washington State. Aurora does not need homeowners education. Boost does only for the lower score. So the 580 to 619 requires homeowners education, but it's a breeze. It's any HUD approved course. You could even do framework or home view. Payment shock. Now this doesn't affect a lot of your loans, but Aurora has a cap just for the very low scores. So Aurora goes down to a 600. The 600 to 620 is capped at 225% payment shock, but that payment shock cap can be completely waived for those low scores if they have either 1 month reserves left over after closing, or their front end housing ratio is under 36%. So that cap is only for 620 or under scores, and it can be waived if they meet either one of those criteria listed there. So if you have the 620 or under score for Aurora, and you know that let's say they're rent free, they're gonna be over that payment shock, then just make sure you have 1 month reserves left over after closing, or a lower housing ratio of 36% or less. Boost has no payment shock rules. So I do want to do a deeper dive real quick into manual underwriting. None of this that we're about to cover in the next couple of minutes applies to DPA loans that are not a manual. So I just want to emphasize that these next few slides, manual underwriting only. So we're going to go over what HUD requires on a manual underwriting. And by the way, these manual underwriting guides are for all FHA loans that are manual underwrites. So this is a good refresher for you guys if the loan is down payment assistance or is not down payment assistance, because this is what HUD requires on a manual. So you can see here we're in the 4000.1 HUD handbook. This is what HUD requires on a manual for the DTI. I'm going to strike out these scores under 580 because our minimum score for down payment assistance is a 580. So that doesn't apply to us. So 580 and up, no compensating factors at all. You're going to be capped at 31 over 43 on manual underwrites. If you do have a compensating factor, and HUD lists them out, you can't make them up. You can't just say this is a comp factor. It has to be one of these listed in the HUD handbook. If you have one of these, you can go up to 37 over 47. What is cash reserve? So in the pages following this in the HUD handbook, it explains that what they're calling cash reserves is 3 months PITI left over after closing. So if you have that, then you can go up to 37.47. Also, it could be a minimal increase in housing, which they define as the lesser of $100 or a 5% increase in housing. That is one of the options. Or if they are meeting residual income, and a lot of borrowers do, HUD uses the VA residual income calculation, even though these are FHA loans. So just one of those, and you can go up to 37.47 on the DTI. If our mortgage is their only debt, they have no other debt, no credit cards, no installment loans, then you're capped at 40 over 40. And if you have two of these compensating factors, you can go up to a maximum of 50% on a manual underwrite on the back end. So 40 on the front end housing ratio, 50 on the back. It's the same compensating factors listed. The only one they're adding here is if we have significant additional income of our borrower that we are documenting in the file, but we're not using to qualify. So let's say they just started also getting commission 12 months ago in addition to their salary, but we don't need it to qualify, then for some reason we can't use it to qualify. Actually, let's say they've only been getting commission for 10 months and we can't use it to qualify because they don't have the history there. But we see it documented in the file, then we can use that as a compensating factor. It does have to be our borrower's income. You can't say, well, can we use the spouse that's not on the loan? Can we use that? No, it has to be our borrower's income that we're not using to qualify. So this is what HUD requires on a manual for housing history. Obviously, if they have a mortgage, we can use their mortgage history of the house that they're living in. It just needs to be clean for 12 months. We can also take a credit supplement if they're paying rent. Actually, the underwriters prefer this. This is the cleanest, easiest way to document that they've been paying rent 12 months on time, is to just put it on the credit report. So that way we don't have to even mess with the VOR or anything. Another option is, though, to get a VOR for 12 months. We even accept a private VOR if they're renting from an individual, as long as it's not a family member that they're renting from, and it's also not the seller. So if they're buying the home that they're renting now, we're not going to take we can't do it in that case because it's an identity of interest. We would need 12 months cancel checks in that case. And that is the fourth option, is 12 months cancel checks. It's just one of these that, obviously whichever one applies is the one that you're going to need to meet HUD guidelines. If they're not paying rent, then we need a rent-free letter signed by the owner of the property that they're living in, or the landlord of the property that they're living in, saying that they've been living there since X date and they don't require any rent. Let's say they're living with the parents and they don't pay any rent and the parents own the home, then we would need a rent-free letter signed by the parents. So again, we're just talking about manual underwrites right now. We're not talking about DPA loans that are approve eligible and are not a manual. So what HUD requires on a manual underwriting for FHA, the bare minimum that they're going to want is 1 month PITI left over after closing for all manuals. This applies whether your loan is down payment assistance or not. So if you just have a regular FHA loan that's referring, HUD is going to require a minimum of 1 month PITI left over after closing if the home is 1 to 2 units. If the property is a 3 to 4 unit property, you're going to need 3 months PITI left over after closing. The number one thing that kills manual underwrites is the credit. So if you're multitasking, pay attention to this part. We're going to go over what HUD requires for a manual underwrite on all FHA loans. So this is whether it's down payment assistance or not. This is what HUD requires when it's a manual underwrite. Number one, before you do anything else, check installment and housing debts on the credit report and make sure they have not one single installment or housing late in the past 12 months. Usually when we have loans that are declined for manuals, it's usually because they have an auto late in the past 12 months or something like that. So this is what HUD requires on a manual: no installment or housing lates at all in the past 12 months. And then you have to look at the year before, and they can have up to 2 30-day lates the prior year on installment or housing lates. No 60-day lates on installment or housing the prior year, but they can have up to 2 30-day lates that prior year. So also you need to look at installment collections and charge-offs. This includes utilities. So they cannot have any, it includes phone, it includes cable, no recent collection or charge-offs in the last 24 months on manual underwrite. So if you look at their credit and they just had a Comcast charge-off or collection hit in the last 24 months, then that is going to make them ineligible unless you can clearly document that that is an old collection that just hit in the last 24 months, but it was actually a debt from prior. You would have to document that. So HUD doesn't want any new collections or charge-offs on installment accounts in the last 24 months. Revolving accounts are much more flexible. So revolving accounts, you can go have up to 3 60-day lates in the last 12 months, as long as there's no lates over 90 days on revolving. So much more flexible. You do need to look at collections and charge-offs on revolving, but it's just a 12-month look back. So when you're looking at the credit report, going down to the collections, make sure there's no revolving credit card accounts that just went into collection in the last 12 months. We're going to look at some examples. So I'm putting the requirements that we just talked about at the bottom of the screen. We're going to look at some credit reports. So what do you guys think about this one? So you can put it in the chat if you want, or you can just think about it in your head. You're looking at the credit report, and this is a collection that just popped up March 2023, and it is Sprint, which would be like phone or internet. What are your thoughts? Is this going to work with a manual underwrite? It is not. So spoiler alert, this is not okay. You cannot have any new installment collections that does include utilities in the last 24 months on a manual underwrite. Now, this is something I get asked a lot. What if they paid it? It does not matter if they paid it or not, or if they pay it at closing. Does not make any difference. HUD is just looking at the fact that it happened, and it happened within the last 24 months. So you want to check those out. Let's look at another one. So first thing you want to look at is what type of accounts are these? So these are installment accounts. So we're going to be following HUD's installment guidelines on manuals. And then you want to look at the dates. What were the dates? So remember, on installment accounts, you've got to do a 24-month look back. They cannot have any lates in the most recent 12 months, and then no more than 2 times 30 the year prior. And although this looks pretty bad, this actually works because all of these are 24 months out on installment. So this one would actually be okay. Let's look at another one. So this is collection accounts on credit. You got to look at what type they are. So both of these are revolving. So we're down to these revolving guidelines, collections and charge-offs. You cannot have any new collections and charge-offs within the last 12 months. And then also you've got to look at the lates. So we're only doing a 12-month look back on revolving accounts for the lates, and you're capped at a maximum. There's actually no cap on 30-day lates for revolving accounts, which is surprising. So 30-day lates are fine, but you cannot go over 3 times 60 in the last 12 months. So if it's October 2023, we're going back to October 2022 as far as the look back, and we're actually okay on these. So even though this looks terrible, this would actually be okay, because for revolving accounts, we're doing a 12-month look back, and these are outside that. Let's look at these. These are student loans. So these student loan lates are actually all outside of 24 months, which is good. So what I would say on this one is that we need to make sure that we are pulling a clear CAVRs, because like all FHA loans, regardless of down payment assistance or not, we have to pull a CAVRs, and it has to be clear. So you just want to make sure that we're going to pull that and set up for you. And they can't have any current government loans, which does include government student loans that are in default or delinquent. But these lates are outside 24 months. I think this is the last one. So these are auto account. This is an auto account, which would fall under the installments. You just have to make sure that there's none in the most recent 12 months, and that no more than 2 times 30 in the last 24 months. So this first auto account is fine. And then This second one is medical, and just an FYI, medical collections are always okay. It doesn't even matter if they were last month. Medical is always fine. Medical collections, you can just completely ignore them on credit. So back to down payment assistance. Who, when you're trying to qualify your borrowers, who is not a good fit for down payment assistance? Borrowers with ultra high DTIs, I would not suggest, because if you're doing a repayable DPA in particular, and you add in that second mortgage, it's going to blow you out. It's going to blow your DTI out. So if you have someone with a high DTI, you're going to need to do forgivable. You're going to need high seller contributions for forgivable always. And you're just going to need to run it and make sure it approves, because as we saw, HUD does not allow any manual underwrites over 50%. So that would be something you want to really check out. You can send that credit and DU to me, and I'll check it out for you as well. Also, another situation that's not a good fit is borrowers who have no money to contribute towards the closing, and also no seller contributions. That's not going to work, because as we saw in our examples, there, even with the repayable DPA, there's still a couple grand that needed to be brought to the closing table. So they've either got to have a little bit of their own funds or some seller contributions. So those of you who have checked out our STAR portal know that it's incredible. Our company spent about $6 million on our portal. I think it's the best one out there. As we took a look at our quick pricer, it's very easy to use. When you're uploading a loan, it does the QM test for you as well. It automatically applies seller contributions to any discount points so that you pass, just without you even having to reach out for assistance. So it's very intuitive. It's going to structure the loan for you. So even if you don't have the second mortgage in your 3.4 Fannie Mae file, that is no problem. You can just have it structured as a regular FHA loan if you want in your 3.4. And when you pull it in and mark the DPA program, it's going to add that second mortgage for you and structure it for you. We're going to issue all of the disclosures for you on DPA loans on both the first and the second. So other loan types, you can click a button, automatically send out the disclosures instantly, but not on DPA. We're going to have you click a button to request the disclosures, and then we're going to prepare them and send them out for you within 1 business day on the first and the second. You're just going to have one loan number to manage in our portal, which is awesome. I know with some other lenders, you've got conditions on one loan number for the first, and then conditions on another loan number for the second. That's not how it works. Everything's just going to be under one file in our portal on DPA loans. Just a heads up, you always want to tell your borrowers they're going to have 2 sets of docs every time disclosures go out. So you're going to have 2 initial packages, 2 1003s, 2 LEs, 2 CDs, and 2 actual closing packages at the closing table, 1 on the first, 1 on the second. Even if you're doing the forgivable, still are going to have 2 sets. Our portal will pull title fees in for you automatically, which is awesome. It's a really cool feature. It's not fluffing them or inflating them. It's actually, when you select the title company, it's going to pull in their live fees, which is a service that we pay for, and we'll actually guarantee that they're correct, or we'll cure them. So it's a really cool a cool feature when you're entering fees on our site. You can run dual AUS, that's optional, and compare DU and LP side by side. We like to get our CDs out early, so we always list the CD conditions right at the top of every approval. As soon as you submit those, we're going to get the CD out. We like to get those out at least 10 days before closing, if possible, because we know everybody wants to get that out. Also, we don't hide our underwriters, so if you have any senior underwriter questions, they're listed at the top of all underwrites. The senior underwriters only handle the income, assets, and appraisal. So if you have a question about disclosures, anything, homeowners association, title conditions, any of that, you would want to reach out to the account manager, who is also listed at the top of your underwrites. So if you haven't done a STAR portal training, you can scan these QR codes and do one. I think our portal is very intuitive. I would say you probably don't even need to do a training, but if you want, you can. I like to point out that we have a Galexa help chat in our portal. So if you click on Galexa at the bottom of your screen, it's going to pop up the most commonly asked questions, and it will start as automated, but there will always be an option during the hours that they're on, which is 10 a.m. Eastern time to 9 p.m. Eastern time. If you're on the chat during that time, there will always be an option to transfer to a live agent. if your question is not one of the ones that it has listed. This is a really cool feature. I was actually a marketing major. I love marketing. We have the best marketing studio that's out there in our portal. It's completely free to you. So once you log into our portal, click on Marketing Studio at the top. And these are not boring, bland, cheesy stuff. This is top-notch stuff that looks really, really sharp. It's not just on DPA loans. You'll see options for all loan programs in there. Everything's fully customizable. There's even social media posts. And by the way, I took these screenshots from my account, so it's showing Orion Lending because that's the company I work for. When you guys go in there, you can upload your logo. It's not going to be branded with Orion Lending. It's going to have your name and information, your logo on there. And there's just tons and tons of cool stuff, even stuff that you can make for your real estate agents for their open houses, that kind of stuff. And everything is in English or Spanish. You pick one when you're designing your materials. We have employees in every time zone. Like I mentioned before, if you guys need a login, it's this one at the top, starhelp@orionlending.com. This scenarios desk is one of my favorites. So anytime you guys have a tough scenario, you can email it to the scenarios desk. Just be sure that you CC me because they're versed with guidelines, but so am I. So I want to give you some feedback as well. So make sure you CC me on all of those emails to the scenarios desk. So that's about it, guys. That is all that I had on DPA and manual underwrites for DPA. As I mentioned, we had Michelle, one of our VPs, in the chat. It looks like she's knocked out all of the questions. If you want to watch any of my most recently recorded webinars, I did one on our DSCR. We have a fantastic DSCR program with the top pricing in the country. We're usually number one in Loan Sifter on DSCR. You can scan this QR code. It'll take you to those. I also did a deep dive into manual underwriting for FHA. But we're going to hang out for a minute and see if you guys had any additional questions. If you did not have any questions, thank you so much for joining. I appreciate your time and looking forward to working with you on some DPA loans here very soon.